Markets have bounced up and kind of broke out a little bit today on a strong jobs number. So we're going to break that down, break down our posture and a few red flags that are cropping up here that just give us a little bit of pause in terms of how bullish we can be. We'll talk about how that jives with our expectations on a more intermediate basis, even if our near-term expectations might be a little different. So I'm going to talk about the differences there and how to reconcile those two. We're going to go without the camera. I've learned my lesson not to use the camera whenever I'm really tired and I've got the bloodshot eyes, so it doesn't look like I've been boozing it up or smoking the weed before I do these videos, because that's not the case. It's just that I end up staying up late sometimes to do these especially during basketball season. So our trade idea of the day is a stock itself that's breaking out in a sector that appears to be looking more bullish as economic growth expectations maybe start to ramp up a little bit. So I'll break that down as well. Let's go ahead and get started. Today is Friday, December the 6th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and take a look at the market forecast here on the S&P 500 first. And you can see, despite the rally that we had today, a nice little post-jobs report rally, the intermediate line still is weakly bearish. So it's still, we got still pink shading, but that's not a bad thing. It's nothing wrong with that. Obviously, it's about as weak of a bearish pattern as you can possibly get. You notice the market sentiment is above 80, so that's a very good sign for the markets to have it that high. It just shows how strong this bullish trend is. You can see the near-term line has bounced back into the upper reversal zone. This is now, multiple days of it being above 50. The expectation is 7 to 12 days. Considering that we're still kind of coming out of this really long extended run, but this looks like it's to be part of the choppiness. We've had a positive run here before, but it ended pretty quickly and dipped its toe under the water. They're 20 without getting too bearish, but you can kind of see the choppiness, and I wouldn't be surprised if this choppiness is not over if we don't come back down towards 3,100, maybe even a little bit below that, towards that 23% retracement, and maybe even give us a yellow line on the moving average before bouncing back up. That tends to happen after you get the long, this was like 6 weeks worth of a near-term rally that typically only lasts, 1.5 to 2 weeks. So I wouldn't be surprised if we're not done with that type of movement yet. One thing to consider on the S&P, though, when you look at the weekly chart, is we got a cluster on here, an overbought cluster, weeks after the near-term line has been up above 50. And not only that, but this cluster, unlike the ones that we had here where the near-term line barely had started, and over here you had some clusters at the end of a near-term rally as well, weeks after the near-term line had popped up, and we even had a bearish divergence on the near-term line on these two clusters, and we're getting a bearish divergence now. But you go back to all the way over here, this was the last time. Well, these two actually were the last time, and well, all these clusters right here also included the market sentiment line. Now this one had the market sentiment line barely rising, so it looks very, very, very familiar to what we're seeing here, where we are just coming off of a death cross low. We had been kind of flirting with new highs. We finally broke out to new highs, and then we got that cluster. So there was some volatility afterwards. You can see that brought the near-term line down below 50. So now it didn't bring the S&P down very much, but it created some volatility here in March, April of 2017. So there's a possibility we get that type of pattern. I don't think we are into January because we're not nearly as euphoric now as we were back then. Remember that was like the whole year of the market sentiment line being above 80. The market sentiment line just barely crossed above 80, about the same as this pattern that we saw over here. And this pattern, again, was closer to the beginning of a near-term rally than it was the end of one. This one, remember, we are weeks into this near-term rally. So there's a possibility, especially with the long lower shadow. You see that also on the Dow Jones Industrial Average with its own cluster. The NASDAQ Composite also shows its own long lower shadow, very close to a cluster. And then the Russell 2000 with its long lower shadow and also very, very close to its own cluster. This is a little different because the market sentiment line on the weekly chart is barely rising, and the intermediate line is just barely got above 80. So it kind of shows that the Russell 2000 is actually a lot closer to what may be the beginning of a bullish run. You can see the green line and dark green shading just barely started on the weekly chart, whereas on some of these others you can see we've been dark green and green lines for quite a while with intermediate pink shading. See, we got more than just light pink shading. We have red lines and dark pink shading on the Russell 2000, and you can see the S&P. So very strong bullish trends for all of these except for the Russell, which looks like it's just starting to get dark green shading and a green line. So it might be a reflection of risk appetite as a whole, not just the S&P 500, which has been bullish on its own, but risk appetite as a whole appears to be starting to rally again. All right, as we switch to the weekly chart here, there are a few red flags that are showing up. One of them is this transition candle. I also broke down a few other red flags that are cropping up in the markets in terms of how bullish we've been and the potentially not being nearly as bullish here in the next so many weeks based on these red flags. But we also talked in our technical analysis class today on MarketScholars.com about how to reconcile a really good strong trend and bullish expectations with these red flags. What do they mean? How do we trade them? Those are all things I broke down. And again, like I said, one of them is this transition candle on the Heikin Ashi. Again, if you're watching this on our blog, remember there's a link to our Plus subscription above the video, which gives you access to all of our trading rooms, including my technical analysis class, including the archive of what we did today and all the archives that we had. So if you want some more discussion on that, make sure you subscribe to at least our Plus plan so you can get access to that class. And if we go to look at the 3 green arrow chart here for the S&P 500, you'll see that we still have 2, but you notice the MACD histogram is rising. I don't expect it to go up too much, right, or even get above 0. You can once we've had our surge, which is this right here, our MACD surge, then every other bullish run is smaller, right? We don't it can still be like up into these kind of smaller levels, but you don't expect it to be as big. And you can see some context here. You see once you get the surges, and that you can see how much bigger they are. Once you get that initial surge, every other move on the MACD is much smaller. Then you get initial surge, much smaller, initial surge, and then the pullback, and here's our initial surge, and any bullish moves we get afterwards. I mean, look over here. Here's your initial surge over here, and then you get smaller MACDs. Here's your initial surge, a smaller move here, and then you got the pullback, and that's just how the MACD works. And so now, as we rally and get that stochastics back up above 75, like over here in these other examples, then don't expect the MACD to be too bullish, which means we won't get nearly the same extent bullish moves now as we did over here, because the volatility is not nearly as high now as it was back here. Here's what the 2-line version looks like of that chart. You can see the MACD is pulled down and looks like it's trying to make a run back towards its moving average. Same thing with the stochastics. And we're back easily above the 8-day moving average with all 3 lines rising. So you can't really get more bullish pattern than that. When you look at the 4-week range here, here's another reason why I'm a little skeptical going into next week. A lot of today's move actually occurred overnight on really low volume, which means that now that we're up here, here's the tightrope, here's the ground. It's very easy for us to come back down to the ground if we come off the tightrope. Because there's very little volume in the way until you get down to about 312. So don't be surprised. Again, there's not a whole lot of volume on this. This wasn't a significant resistance level, so I wouldn't consider that a breakaway gap. which means there's a very good chance it gets filled in sooner rather than later. So whether it's Monday, Tuesday, but sometime early next week, I wouldn't be surprised if we don't make a move back down to 312. Maybe even after we get a new high tag over here on the right. Maybe even pop up above this a little bit and get a new high tag, then come down, fill in the gap. The low tag after Monday is going to move all the way over here to this low point, to what, 307.13, which means that we'll have both the low and the high tag on the right hand side of the chart. Something that's, you know, a little concerning, but as long as that support holds at 312, then we don't have to worry too much about any significant declines. Even if we break 312, excuse me, 309 will be another layer of support, especially when you look at the daily chart. Here, let's go to this one instead. When you look at the daily chart here, here's where that 312 area is, the volume node. There's 309, so there's another support. Now, if we break down below that, then a move down to 300, 301, these old highs over here will be the expectation. I don't that's kind of worst case scenario. That would be more of an intermediate pullback that I don't think that we'll get on any near-term run drop that we'll have here in the near future. You can see, you know, from some other perspectives here, you look at the Bollinger Bands for SPY, and we are in strong bullish territory. We're above 5 or above 80 on this line. That's what these lines represent. So we're above strong bullish patterns here. You see that we are back above the green line. Both lines up above the cloud. This red line is today's close, but charted 26 days ago. So that's how far up above we are the price 26 days ago. So it's a pretty bullish pattern and strong bullish trend across the board. And you can see when you get above this 5 and 80 level, you can be strong for a while. In fact, if you go again for some context on this, you can see other instances where we got above 5 and got above 80, and how long even over here, how long those bullish trends last once we get to those levels. So it appears even over here, we went, a couple of months, maybe a month and a half at these higher levels before we finally had some pullback back down into the cloud. The volatility index is showing kind of some interesting patterns here. We had made this nice run up to 18 here to start the month of December after a very, very low volatility month in November. We're already back down here to where we were. Basically, the highs of November is where we're at now. So there might be a little bit of support here in volatility. I wouldn't be surprised if we don't get a little bit more of a run on the volatility to make a run off of a higher low at these old highs. In fact, here, if I go out a little bit further, you can kind of see there's the old high. So if we kind of hold this for support, and we are in, not necessarily extremely oversold areas on volatility, but we are in the lower half of the bullish range, so more oversold than not, just not to the extreme when you get below 80%. So I'm kind of watching to see if that kind of aligns with this expectation of filling in that gap early Monday or Tuesday, early next week, and seeing if we don't get another little bounce in volatility back up towards 16, 17 area again. On the daily chart, you can really see that pattern developed as from these old high points here, and we're right back down to it. So we'll see if that ends up holding, at least on a temporary basis within, maybe for a day or two. See if that ends up holding for a new support level after this, a little bit of a breakout pattern here, and then a bounce up before we grind our way back down again. All right, as we now transition toward what's driving the price action today, you can see the big winner on the week, which kind of put everything else out of scale down there, was crude oil. Crude oil was up over 6%. Big move higher on Wednesday that held its gains into Thursday and Friday. On the other hand, the dollar suffered. Eventually, equities rallied, especially emerging markets. Gold was strong until today. Gold dropped with a little bit of a bounce in the dollar today. You can also see two REITs REITs fell down. Real estate fell down. High yield was flat on the week, very flat. The S&P ended up being relatively flat on the week, and the S&P outperformed, or the small cap index outperformed the S&P. So good moves higher here. You don't see the treasuries here. Let's see if I can get go back another day maybe and get the treasury, since we don't have a Friday here. So let's go to Thursday. So you can see the move in treasuries, and then you can see, okay, over here, we had it's down pretty much. I mean, we started the week down on treasuries from where we finished, not including, it doesn't have the Friday data on here for some odd reason, but then we bounced up on Tuesday before falling the rest of the day, rest of the week. So when you look at some of these charts, like for example, crude oil, which had such a strong week here. Here, let's go to like a, so we can kind of zoom in. There's the candle on crude oil, and you can see we've had this bullish trend, some pretty big transition candles right around where this Fibonacci retracement, the top end of this retracement zone that we're trying to break out of and get back going to the upside. Well, you can see, if I were to show an actual candle here, very bullish candle this week. In fact, closing above the highs of a bunch of these weeks here. So little bit of a breakout move in crude oil. You can consider that a little bit of a breakout move. And again, commodities move last on bullish moves, and to see crude oil kind of bounce off of this buy the dip signal here and then break out a little bit and get going again on a bullish pattern across a lot of these different indicators is a really good sign. And the fact that it's just starting is a good sign that there could be some time left in this little intermediate run that we've been on, despite the fact that we could get a little bit of weakness. If we take a look at the let's take a quick zoom in a little bit and take a look at like TLT. Remember, TLT had a kind of a up and down week. Well, we bounced up a little bit here on short-term bonds, and then we got this transition candle that could lead to, similar to this move here, to multiple weeks of declines. And so again, I mean, you look at the regular candlestick, that's what it looks like. It's a long upper shadow. It's a pretty bearish pattern. So an opportunity for some bearishness to reemerge on long-term bonds, which again is another sign that we might be turning risk appetite back up. Remember, TLT is very, very bullish in terms of a long-term. I mean, look at this is the long-term chart. We're just barely getting to its moving average. It's 30-week moving average, and lots of light pink shading here. But you see lots of oversold momentum lines too, turning things around, bringing the intermediate line down, and looking like it might be trying to produce this type of pattern here that we saw at the end of 2016. So there might be some short-term weakness here, but there's still plenty of opportunity. These safe haven trades have sold off from very, very high levels, but they're not necessarily close to selling off to oversold levels. Here's GLD. Here, let's go to the 5-year chart that was so bullish. You can see there, it's not even it's not even back down to its linear regression yet, and the same thing would apply to TLT. Lots of room for, and that's kind of one of the main reasons why I've been bullish here since October, and we've been talking about this a lot in my portfolio management class. And the main reason, and I've talked about it a little bit here a few times in the market outlook videos, is this unwind of this extremely bullish safety trade, as the market here this year was anticipating recession with the inverted yield curve, that this didn't come about, and the Fed cut rates, and the market looked at that as a bad sign, which has been a bad sign before, but since we didn't cut rates by 50 basis points ever, and we only got 3 of them rate cuts, then there's a good sign that this is actually just one of those pauses, and that we were extremely overbought in the safety trade, anticipating something that inverted yield curve and the Fed policy change moves suggested never came about. This recession never came about there. I mentioned yesterday's video that part of the other reason why I've been so bullish is because there's been a broad, wrong chart. There's been a broad participation across a lot of these major economies where we didn't have that for most of the year. Well, you can see a lot of these major economies are showing kind of bullish buy the dip patterns, a little bit more weakness in China and South Korea, but they're bouncing up the most here in these today. So a lot of these good strong patterns. Look at Brazil. I mean, everything is starting to bounce back up again. You do have some falling moving averages and a couple rising here that are below 20, China and South Korea, but the rest of these are still falling, but you notice they're in their 40s. They'll turn around and get to light green shading and then get back above 50 and they're back to dark green shading like Japan here, which is continuing to be really, I mean, that's our strongest trend right now, up above 86, almost at 87 on the intermediate line, with an easily strong rising moving average that over the last 3 months hasn't been. If you recall on these, if I were to take a look here, let's do this. Let me move this over and change this to a 3 year. Again, this kind of goes back to that January 2018 time frame. You can see where everything peaked, where everything is starting to work its way back up again. You see that? So we kind of lose all the indicators when we get to weekly charts here. But you get the idea that January 2018 was a significant level for a lot of these major economies. Some of them are starting to bounce back up more than others, but you can see, especially these developed markets are breaking out a little bit, similar to what the Russell 2000 is. So it kind of, again, shows the broad participation. We prefer to see China and South Korea kind of make their way too, considering how important their economies are to the trade, to global trade. And a lot of, again, these ETFs are based on stocks in those countries, not necessarily a reflection of their economy. But we know stock markets can price in economic expectations as well as individual earnings expectations on those bigger issues in those collections of stocks. Looking at the jobs numbers for today here, let's refresh this page. You can see we had a very, very strong jobs report, and you'll see here in a second. Let me pull this up. There's the job report there, very strong compared to the consensus, compared to the prior number. Average hourly earnings year over year came in a little bit higher, but the revised number was strong, so it actually dropped from the revised number from the previous level. So, getting jobs growth without significant earning or inflation growth is actually a pretty decent sign, even if you're getting a smaller level of participation, slightly smaller level of participation. When you look at the economics surprise index as a reflection of how well we're doing on these different indicators compared to estimates, you can see we're bouncing back up towards positive levels, at least in the U.S. What that has done is pretty much taken away any odds at all of a rate. I mean, there's still slight odds, 30% by April, go out to December, and you can see the odds of a rate cut have dropped from 38 down to 32 here. You also see that we have odds of a rate cut going from 18 up to 39. So the market's actually pricing in more rate cut odds by the end of next year. Now we're looking at a couple potential rate cuts between now and the end of December. How and when those will be delivered and how they're spaced obviously will depend upon all the different factors that the Fed looks at. But the concern would be, is there any odds of a rate hike? And you see by the end of next year, there's literally zero odds of a rate hike. So we're as bullish as that report is, and high as inflation is for earnings, there still is very, very little worry or concern about rising inflation that the Fed would have to combat with raising interest rates. And as long as that ends up being the case going forward into December, that's a good sign for stock markets, because stock markets do well when the Fed is got more of a dovish stance than a hawkish stance. Now let's take a look at the different sectors and compare how they've done. Here we go on the 12 grid. Remember, our biggest winners here lately has been industrials and financials and healthcare. You can see Staples is actually looking pretty strong. There's technology and communication services join the party. Materials is bouncing back up and looks to get back into, you see a little bit of a breakout pattern here today, kind of joining the party more so than even say industrials is. But you still have some these sectors, utilities and real estate, are ones to avoid. Discretionary looks like to be one to avoid as well, as it's pretty sideways. And energy still looks like one to avoid until it breaks out. And remember, we can also look at the weekly charts for a lot of these patterns, a lot of these sectors as well. These kind of long, we look at that energy sector and its performance versus say like utilities and real estate, which have been so bullish. Now they have that potential to roll back over. Look at consumer staples as well. You can see finally financials finally breaking out above those January 18 highs, and industrials finally breaking out. Remember, look at technology, how high it is above those January 18 highs. Material still isn't there yet. So there's still some room to run for some of these sectors. Energy is not anywhere close. But materials and industrials are more dollar sensitive than some of these other areas. And if we consider the direction of the dollar and what it might do, that's going to have an impact. And as long as yields continue to rise, that will also have an impact on the financials. So I think, as bullish as financials and industrials have been, and not so much healthcare, right? But you can see a little bit of a breakout pattern from the October highs on healthcare over the last so many weeks. You can see that these sectors, as bullish as they've been to be the strongest sectors right now, financials, industrials, healthcare, you can see compared to some of these bullish moves in these other areas, it looks like there's some room to run. In those particular outperformers right now. All right, so for our trade idea of the day, I want to take a look at one of those materials companies with the materials sector, kind of a little bit of a breakout here today at least. Nucor, we didn't do a market outlook live, so you can see the trade idea is going to go in for Monday morning, and we'll see if we get filled in on that. But if you take a look, look at the strong bullish pattern that we've had and what it's done, this little bullish move. We've been so bearish on a lot of these materials companies. You can see the death cross environment we've been in this whole time since January 18, finally getting a golden cross and a pretty bullish weekly candle here this week, getting above a lot of these highs here after the initial surge above the 200-day moving average. But getting a golden cross, you look at the 3 green arrow chart for Nucor, and you can see the MACD is starting to make a run. There's the initial surge and the successive run, and now a higher low point and the potential for a new higher high coming out of this, with this old high acting as a support area. Good, strong, positive momentum that's growing up above a rising 8-day moving average, easily above rising 8-day moving average. You take a look at its Ichimoku cloud, you can see well above. Very strong trend. If I give you some context on that trend there, you can see again, getting above 5 and getting above 8 can be a significant thing for a lot of these companies. It's one thing to not get to 5 like some of these other peaks, but once you do and you get these strong trends, they can last for a little bit of time. And you can see however you want to draw your line coming down these highs. So however you want to draw your lines coming down these highs to try to give it a best fit you can. And obviously a little bit of a breakout pattern there that's led us to this strong trend that could persist. So we don't want to chase the trend necessarily, but we can do a good with that really strong support level below us. We have an opportunity to sell a put option around those levels here. And so what I've done is, as I go to NUE, you can see I've got a short put here at 56, buying the 54 on the January 24th weekly. What that's done is it's given me again, I need at least 47 cents and a $2 wide. I'm getting 53, and I'm also position sizing smaller because of these red flags that I mentioned to you before. So a little bit smaller than my normal risk, just in case to try to keep my delta small, just in case things do turn around in the broader market. I don't want to be caught holding a bunch of really strong, aggressive, large bullish positions that end up all getting stopped out at the same time with, relatively bigger losses compared to what we're putting at stake here, at least on a worst case scenario. Ideally, I want to keep my loss to $265, which would be kind of right around, below this 55 level, where you'd have to break through essentially that point of control and this big volume node, which is going to act as a significant support level now that we've broken out above it today. All right, well, that wraps us up for today. As always, thank you all very much for coming on and watching our video here this weekend. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and let us know that you liked our video, you want us to do it again. Comment on the video. Follow me on Twitter for more content in between videos. Join our community, our Market Scholars community, for free at our website, as well as our Facebook group that we created for Market Outlook viewers, so you can be able to interact and engage with each other. You can join that on Facebook. Just search Market Outlook, Market Scholars. You'll be able to find that group there. Again, thanks. Have a great rest of your weekend, everybody, and we'll see you all on Monday.